Welcome back to Market on Close. 8 minutes till the bell. Stocks firm. Nasdaq near the highs of the day. The rally rages on. Joe Mazzola and Collin Martin join me. Joe, Director of Trading and Education, and Collin Martin, Director of Fixed Income Strategist. Hey guys, good afternoon. Joe, get us started here. There's a lot to pick from this week. What's your top story?
I'm going to drop the F word on you. We're going to go to fundamentals, Oliver. They matter again. Yeah, it's a family show, so I'll keep it clean. No, they matter again. And I think that as you kind of go back and look at earnings, you could say 77% of the companies beat on the bottom line, and that's a bit below the 5-year average. But when you look at how analyst estimates had come down so dramatically from the end of September down to December, even in the beginning of January, expectations went from about 8% down to about 1%. And we're going to come out probably somewhere around 4 to 5%. So those are better. When you look at, 7 of the 11 S&P 500 sectors reported year-over-year earnings per share growth, that's pretty good. Like I said, I'm not going to give it an A+, but I think you can give it a B+. And I think it was enough for investors to kind of look at those macro headwinds and say, you know what, earnings growth is strong enough, and the revisions are strong enough, especially in technology. 88% of tech stocks within the S&P 500 beat their earnings estimate. So I think, investors are gravitating towards those names, those sectors. Maybe it's not as evenly distributed as we would like, but there's enough juice behind it.
Yeah, enough juice behind earnings and not enough juice behind rates, yields to get in the way, it seems, Collin. Anytime it looks like we're about to blast off again for Treasury yields, we get stopped out. Today, particularly, in this week, a big reversal in the 2-year lower.
Yeah, big reversal today and really for the whole week. If you go back to Monday's high, we're down about 15 basis points on the 2-year. And I'll follow up on what Joe was talking about, the F word. We have Fed officials, and there's a lot of commentary this week. And we've generally got the same theme where they're talking about patience. They're reiterating the idea of higher for longer to kind of see how the data comes along. We got one thing that was interesting as it relates to short-term treasuries, and that's how the 2-year ties in a little bit. Fed Governor Chris Waller was talking about the balance sheet and the idea of focusing more on short-term holdings because they kind of got away from that over the past number of years, where bills used to make up a large chunk of the Fed's balance sheet holdings, and now it's a much smaller size. So that could be one reason. But also, if you look at the economic data over the past few weeks, there's this idea that maybe inflation was reaccelerating, the economy was stronger than expected. And this week, I wouldn't say it threw any cold water on that, but it reined in expectations a little bit. Data was, flat to weak-ish, I guess is a good way to describe it. And if you go to yesterday's PCE report, it kind of came in exactly as the markets were expecting. So no upside surprises.
Okay. Yeah, it seems like generally our economic data have softened a tad. I mean, it's not like there have been big cracks forming, but our economic surprise rate slowed pretty substantially the last 10 days. Joe, it's still positive, still significantly positive. Things are pretty solid. Jobs are continuing to hold steady, but on the margin, a few of those components this week and the past week too slipped a bit.
Yeah, and we will find out even more next week, right? When we get the ISM services, we have the job openings number. We're going to have continuing claims, and then we wrap it up at the end of the week with non-farm payroll. So, I think markets will be looking ahead towards those numbers. Might see a bit of a, kind of a slow grind kind of heading into the back end of the week. So like we saw this week, it was not much going on the first couple of days. I think everybody was waiting for that PCE number. It came in line, which gave the markets a bit of a relief. I think had you seen a hot print there, the markets could have rolled over fairly quickly. But, Oliver, one of the things that still, I think you have to look at to kind of show the strength behind this move is that, when we got that CPI data, we pulled back almost 2% intraday, right? And then really markets just kind of shrugged that off and continue to power forward. So, at some point, everything's going to top out, but at least there's some momentum here.
Okay. Looking for the next commentary from Jerome Powell. Based on what we heard from Fed speakers this past week, Collin, what type of tone do you think the Fed chair will strike?
I think he'll be in line with what we've heard. The idea of patience and waiting for more data. That was the key phrase from his last press conference. The idea that they just want to see more data, not necessarily better, just data that supports the case that inflation will be moving in the right direction. Maybe he'll acknowledge the slightly hotter than expected January inflation data to support his view that maybe they don't need to cut as early as the markets initially expected. But I think he will kind of toe the line that their view hasn't changed and his view hasn't changed. They think that rates at their current levels are doing their job and that the disinflationary trend should resume. We never expected it to be a straight line. I'm sure Fed officials never expected it to be a straight line. So I'm sure he'll hold the line there and talk about the need to see more data and point back to the past few weeks as support for that case.
Okay. The markets seem to be generally happy with the Fed tone. It seems like, Joe, one way to describe kind of the pacification of the market is that the market's coming to terms with the Fed's outline for their cuts, for their rates, and vice versa too. It seems like, we went from the Fed's gonna have to start cutting immediately right now to, all right, let's talk in the middle of the year. And it seems like that's kind of where everybody can agree on.
I mean, I know for sure that Collin will agree with this. I don't think anybody on our side ever expected 5 to 6 cuts, right? I mean, Collin and his team have been looking at 3 to 4 cuts at the most, probably this year, and it keeps getting pushed back, and it's okay. As long as we get to the point that we need to get to at some time in the distant future, I think markets can deal with that. One of the things to look at, Oliver, is if we did get 5 to 6 cuts this year, what would that have meant? I think that's a really important thing to consider. Why would you need 5 to 6 cuts? Because things were falling off a cliff. That's why you would need 5 to 6 cuts. And I think the markets are finally starting to understand that without getting 5 to 6 cuts, that means that things are kind of moving along fairly well. And I think they're becoming more patient, as you mentioned.
Okay. Appreciate it, guys. Thanks for the chat. Collin Martin, Joe Mazzola, good stuff.